What a week this has been. The Fed's evolving, and a more hawkish monetary policy has sparked a big global sell-off. We asked three experts in fixed income, stocks, and currency markets to take a breath, take stock, and tell us what lies ahead in the next week.
So I think the reason for the big market moves last week was because of the disconnect between what we came into the Fed meeting with expectations and what we got out of the Fed. What we got on paper was a modest upgrading of the economy and a modestly more hawkish statement. What we got out of financial markets was a much more violent reaction because of the disconnect between expectations. And what we've really done here is we've shifted dramatically interest rate expectations, not just for the timing of tapering, but more importantly, for the timing of the potential increases in interest rates.
So I would argue that the entire Fed policy normalization related correction began when the April employment report hit in the beginning of May. Now, stock market kept going up, but the parts of the stock market most closely correlated to the bond market, utilities, high dividend payers, started going down immediately with the bond market. That's how every one of these normalization related corrections has unfolded, 83, 94, or 04. So during the first month of these generally 2 to 3 month adjustments to the Fed slowing the level of accommodation has been about the same order of magnitude, irrespective of how aggressive the Fed has been in removing policy accommodation, to use Greenspan speak, right? 7 to 9% roughly. It's begun with the first month being all about interest sensitives, the parts of the stock market most correlated to the bond market. And then in the second month, it broadened out to the cyclical sectors. That's what we're seeing right now.
But at the end of the day, I think what really we need to hear at this point is some of the other central banks express their nonchalant attitude about the need for additional monetary easing. And that could happen from the ECB, it could happen from the Bank of England. So that's really what could kind of bridge the gap between the monetary policies of one country versus another and stem the slide in their currencies versus the US dollar.
So deep breath. It seems we have a much calmer week ahead of us. Unless, of course, we missed something.
China. The reality of the Chinese economy, not just recently, but for many of the post-crisis environment, has been supported by one channel and one channel alone, and that is investment-led spending fueled by rampant credit expansion. And as we've seen before in many histories of financial market crises, there is a limit to the ability of such a system of credit expansion to support economic growth without longer-term consequence. The rise in interbank lending risks may be mitigated in the short term. Liquidity risk is not the risk. Solvency risk is the risk.